Hello NRI friends, welcome to SBNRI, the next generation NRI banking. My name is Mohit, I'm a CA by profession, CFA level 3, and welcome to the next video in our series which will be focused on which Indian mutual funds are allowed for UAE NRIs. It is the follow-up video for our previous video which was on the very same topic, but it was based on USA, NRIs from USA. So let's get on to the video. In this video, we will try to understand what are mutual funds, followed by which Indian mutual funds are allowed for NRIs from UAE, and by the end of the video, we will understand about the taxation aspect of mutual funds. So, what are mutual funds? A mutual fund can be understood as a pool of money that is managed by a professional fund manager. It is something that builds a trust inside of the investors as money is collected from a large number of investors sharing a common investment objective, and investments are done in forms of securities such as equities, bonds, etc. And the income or the gains that is generated from this collective investment is distributed proportionately amongst the investors after deduction of the applicable taxes and levies. Uh, and this particular income is generated by calculating the scheme's net asset value or the NAV. So to understand this concept of net asset value, we can take an example. The very same example I took in my previous video as well in case of US NRIs from US. So if you have not watched that video, please do that. Um, Now coming back to this particular slide wherein we were trying to understand the concept of NAV. So let's say that there is a box of 12 chocolates that costs 40 rupees. Now there are four friends who wants to buy this box of chocolate, but they have 10 rupees each and the shopkeeper only sells by the box. So what the friends decide that they will pool in the 10 rupees that they have and buy the entire box. So this particular thing that they did, the pooling of the money together, can be understood in terms of mutual funds. And now based on their individual contributions, each will receive 3 chocolates from this box of 12 chocolates. This can be understood in terms of units. So if we calculate this particular thing, comparing it with mutual funds, then the cost of one unit can be calculated simply by dividing the total amount of money that is pooled by the number of units excuse me, that is sold out. So that is how we calculate the NAV in terms of mutual funds. And coming to the next topic, which Indian mutual funds are allowed for UAE NRIs? So there is a lot of confusion from NRIs in the UAE, and they have been putting questions again and again. It is a very basic thing we want you to know that you can invest in all the mutual funds available in India. In India, we have around 44 AMCs, that is asset management companies, and investors from UAE can invest in all the funds offered by these AMCs. And to give you a basic understanding of the top AMCs, we are providing you with a list of top 10 AMCs based on the asset under management that they have. So the top 10 mutual fund houses in India are SBI Mutual Fund, HDFC Mutual Fund, ICICI Prudential, Reliance, Aditya Birla Sun Life, DSP, BlackRock Mutual Fund, Kotak Mutual Fund, Tata Mutual Fund, Principal Mutual Fund, and L&T Mutual Fund. And after understanding that you can invest in basically all the mutual funds available in India, you also need to know about the taxation aspect of such investments. So mutual funds can be understood under two aspects, which are equity funds and debt funds, and both of these are taxed differently. So equity funds are a type of mutual fund that invests basically in stocks, principally in stocks. That is the major share of investments are in stocks. Whereas in a debt fund, the major share is not in stocks, but rather it is in other fixed interest generating securities such as corporate bonds or other government securities. So to understand about the taxation part, we need to understand that there is a minimum holding period for long-term capital gains. So for equity funds, this period is of 1 year, and for debt funds, this period is of 3 years. Minimum holding period, we simply mean that if you are investing in any sort of mutual funds and they are sold off before this particular minimum holding period, then you are liable for a short-term capital gain tax. And if they are sold off after this particular minimum holding period, then you are liable for a long-term capital gain tax. So in terms of equity funds, the short-term capital gain taxation is done at 15.60%, including the cess. And in case of debt funds, the short-term capital gain taxation is dependent on your tax rate slab, and which is 31.20% for the highest tax rate slab in India, including the cess aspect. Now, if we talk about the long-term capital gains, for equity funds, it is around 10.40%, including the cess. For long-term gains that exceed rupees 1 lakh. For the gains that are below 1 lakh is not taxable. That is tax-free in India. In case of debt funds, if you are liable for a long-term capital gain tax, then you will have to pay 20% tax along with indexation. So indexation is basically a technique. It can be understood as a technique used to adjust the income payments by means of a price index, and it is done in order to maintain the purchasing power of the public after inflation. And that would be all for the taxation, and it will be all for the video as well. Thank you so much for watching the video. We have more videos in line. The next video will be coming up on NRI life insurance. So stay tuned if you want to know the details of life insurance, the top policies you can get in India being an NRI. And while you wait for that, don't forget to like the video, share the video with a friend, subscribe to the channel, and stay tuned as we come up with our next video. Thank you so much for watching this one.